welcome to another edition of Taking Stock on CNBC TV 18. I'm Sonia, Shenoy, and with me is Ekta, Batra. It was a tough week for the market. In fact, the Nifty and the Sensex were down almost 4% this week. The Bank Nifty fell by almost about 6% or so. And the disappointing bit was that technically the market has now become weak. Every pullback was getting sold into. The only silver lining is the fact that the 8,000 psychological level was protected on the downside. But we have two guests who join us now to analyze the week and to give us some cues to watch out for. Bala of 1857 Advisors and Sanju Verma of Violet Arc Global Managers join into our discussion. Thank you to both of you for joining us on the show. Sanju, I'm going to start off with you. What's the sense you're getting about the market itself? Are we in for some more rough times? And do you think 8,000 could be protected? Or is it just a matter of time before that gets taken out on the downside?
Speaking of the markets, I think there are two very important variables that need to be accounted for. One on the international front and one on the domestic front. I'll first speak on the variable on the international front that has been spooking emerging markets, including India. The general consensus view is that with the rise in bond yields in Germany and in the US, risk aversion is back and how, and that basically means that there will be a flight of capital from emerging markets. But there's a different take that I have on this. Nobody seems to have realized that this time around the rise in bond yields has less to do with any rise in inflationary expectations or growth coming back, because growth is still in the doldrums in the US. The general consensus is that even the 0.2% GDP growth for the first quarter of calendar year in the US is likely to be revised downwards to a contraction, and that is also the sense that I got when I was there for a month in the US last month. You are welcome to basically empty malls and emptier showrooms. So I think that the sell-off in global bonds and the rise in yields basically has less to do with the rise in the risk premium pertaining to inflation. It has more to do with the risk premium pertaining to deflation having come down. So I think as Bill Gross of Janus put it very succinctly, this sell-off in global bonds and the subsequent rise in yields is nothing more than a momentum reversal, because perennially, till kingdom come, for the last 2-3 years, we were investing in bonds as a safe haven. So, the law of averages had to catch up at some point. So my sense is that there is not going to be a flight of capital from emerging markets, because situation globally, particularly in the US, is pretty bleak. And, when I was on your show a couple of months back, I had said that I don't foresee any interest rate increases in the US. And my sense, speaking to some of the global fund managers there who manage large chunks of money, is that before there's a rate hike, there could actually be, small rate cuts. Given that even the second quarter GDP number in the US is not likely to be better than 0.8%. And for everyone who's been rooting about the fact that, unemployment in the US is at 5.4%, they seem to forget that, retail sales is the single biggest indicator that the Fed takes into account. And December 2014 to March 2015, retail sales were down between 0.6 to 0.9, and April it was static. So, nothing much is happening on that front. So there will be no rate increases. And to that extent, emerging markets are safe.
Bala, do you concur with that view technically, that emerging market equities will continue to be relatively perhaps a better game than some of the other markets? And within that, what's your own view on how India will perform?
Yeah, Sonia, the markets that we track, global macro, the sentiment towards India is one of the lowest. So that is actually a positive from a contrarian perspective. There have been many markets that have been falling since March, but the sentiment towards India is one of the lowest. So what that tells us is that, see, we had put in a possibility that 7997 was a very significant low, but there was a 10% probability that that low could go. In the event that it goes, now given the sentiment is so low towards India, the probability that it goes much lower is very low, so it's not going to go much below, it's probably going to hold above 7,800. But from a larger time frame perspective, the structure for India is still positive, and even when you're talking about emerging markets, China is looking very, very frothy. We call this in technical terms as a wave 5 of a 5. So when that happens, it goes through a significant reversal. So you could even work with the thesis that money out of China is good for India. But the structure for India is positive, and there are a lot of structural negatives in the emerging markets which are looking favorable for India.
Okay, Jay, one of the significant things this week was that the Bank Nifty broke 18,000 very decisively. In fact, broke its 200-day moving average as well. It closed at 17,500. How significant a level was that for incremental weakness on the Bank Nifty, according to you?
Yeah, that was an important support, but as long as the May low holds, I think the probability of the market getting higher and surprising everyone is still there. But as long as the important factor for Bank Nifty holding up is SBI not closing below 255. It barely closed above that this week. So basically, we are looking at very important supports for Bank Nifty as well as the Nifty. It's holding above the May lows. As long as those holds, I think the probability that we saw a very significant low in May is still on, but the odds are still receding. Be a bit cautious in the market. Okay.
Sanju, one of the big sectors that were in focus this week was the entire FMCG space. How have you read the news on Nestle as well as ITC, where there was that news about the loose cigarette ban in the state of Maharashtra possibly coming through?
Given that most of these FMCG players have 30 to 40% of their sales coming from rural areas. I will not specifically comment on Nestle or ITC. Between the two, I like ITC. While the results for the fourth quarter were nothing much to write home about, the interesting point is that despite a 14 to 15% fall in volumes, the revenue growth, was still static. I had anticipated the revenue growth to actually inch several notches down, which did not happen. But personally speaking, I think there's so much to choose from within the FMCG space that you really don't have to get into controversial stocks like ITC or Nestle. If I have to look at the pecking order, it would certainly be something like a Dabur, an HUL, a Marico, and an Asian Paints, perhaps in that order. I think one very interesting point, which needs to be, brought home is that in the fourth quarter, the volume growth for some of the biggies surprised on the positive, be it an HUL which had a volume growth of 6% or Dabur which had an volume growth of 8%. I think what increasingly that tells you is that demand is slowly but surely coming back. And the reason why the top line growth was muted, despite a volume of growth of 6%, you only saw a sales growth of 9% from HUL and a 10% sales growth from Dabur. That is because I think companies chose to be discreet, companies chose to be smart, and they passed on the input cost deceleration onto the customers and did not get greedy in terms of raising prices. And I think that was also reflected. The input cost fall was reflected in margins expanding by between 80 basis points to 120 basis points for all key players within the space, be it HUL, be it Asian Paints, be it Dabur, with the sole exception of Marico, which saw a small contraction in margin. So my point is that I think FMCG does look interesting, and for all those who are screaming their lungs off that rural demand is just not picking up, I think people seem to have missed the point that if you take the April inflation print and read in between the lines, rural inflation actually came in at 5.37%, more than the urban inflation at 4.36%. Something which was amplified by Marico's numbers, where the rural growth was 24% year on year, whereas the urban growth for some of their products was just about 18%. So I think rural growth is coming back into the system, but it will take a while before it becomes more visible and more lumpy. So I think as I said, FMCG is something that I'm surely betting on, because when you buy an HUL, you don't want to look at the 30 times or 40 times that it's trading at, but the fact that the return on equity and return on working capital is at 100% and more. So you look at different parameters for different stocks, and I think in terms of efficiency ratios, FMCG stocks certainly rule the roost.
All right, Bala, you were mentioning that from a risk-reward point of view, the downside for this market looks limited now. So if we do manage to see a concrete rebound between two of these pockets, banks and technology, where do you see the highest amount of returns now?
I think banks are an ideal bet. I'm actually not that positive on IT space. That doesn't mean I'm negative there. Basically, what I'm seeing is that the cycle from 2012 lows to 2013 lows, most of the stocks seems to have completed a complete cycle. Once that happens, we could see a complete, a sizable correction come through for the rise from 2013 lows to the highs of 2015. So that's the reason why I'm a bit neutral on IT. But banks, they still have one more leg up. I think from a medium-term perspective, 3 to 6 months perspective, I think banks are heading towards 22,000, 23,000 on the Bank Nifty. So that presents a tremendous low risk and high reward potential. So that's the reason why I'm positive there. If you look at something like an Axis Bank, I think it's looking at you can look at something like 750 over the 3 to 6 months time frame. And even if SBI were to break the 255 level that I spoke, I think the downsides are about 8 to 10%. But once that is done, the short-term correction would be done, and the longer-term trend will take over. So with relation to IT and banks, I'm positive on banks more than IT.
Okay, well, time for a break now. But as we do that, let's get in some market opinion we've had through the week.
We are calling for a flat market into the year end at this point of time. So I would say it's probably close to its fair valuation. But I must confess that there are a couple of red flags which, I'm no soothsayer, but one part could be that in case the monsoon disappoints as the IMD and various other agencies have forecasted, then there is obviously some kind of downside risk that could open up on markets. China, it still remains to be seen how much, valuations are still not as expensive as what you have relative to our market at this point. And at the same time, you also have an issue in terms of what happens to the passive pools of money.
One thing which I'm really worried, and I don't know the time frame for it playing out, and that is the global situation. Again, let's take record that last 5 years, global tailwind has been in our favor. Interest rates are virtually at 0%. There is enormous amount of printing of money which has happened around the world. I don't think, just like being in the market for 20 years, I don't think these are sustainable situations. However, these are big macro calls which are dependent on 15 things.